futures trading, how to reduce risk, Mikey. We talk about this often because it's one of the biggest barriers, I think, for people entering this market is futures. You get the cost effectiveness, the low margins, and that means higher potential returns, but it also means higher potential risk. How can I mute some of that? And right out the gate, the small exchange has the biggest way you can reduce risk is before you even start trading, reduce size. And the small exchange is so named because we try to, from the outset, reduce the size of the products because all markets, Mikey, can pose theoretically infinite risk, but futures can add leverage to that so that, if I'm buying or selling US dollars, if I put up 50% to do it in a stock or an ETF format, yes, I still have theoretically infinite risk. But when I put up 1 or 2%, with the futures, because they're so efficient with my capital, I'm theoretically enhancing that potential return and that potential risk, which can make me really uneasy unless I have a small market like we do with SFX.
Yeah, for the longest time, you were kind of stuck between two places, like a rock and a hard place. You had the capital efficiency of futures, which is great. Like you said, you're putting up maybe 2% of your capital for a foreign exchange trade. But what came with that was huge size and products that were moving hundreds, if not thousands of dollars a day. Now, on the other side of that, you had these great ETFs like UUP or FXE, which allow you to get smaller, but they also cost so much more to trade. You're putting up 50 to 100% of the capital to get that exposure. We've kind of found a nice middle ground with the small exchange products. They are futures, so you get that capital efficient span-like margining. But because of the smaller notional sizes, you're only seeing moves of between $50 and $100 a day, which is kind of a nice sweet spot. You reap the benefits of that capital efficiency with hopefully not too much anxiety of a huge futures position.
Yeah, and it's no coincidence that we're looking at US dollar for reducing risk in futures as an example, because this market is the biggest extreme that we've seen. I know a lot of people want to talk about crude or tech stocks getting beat up, but US dollar is at the biggest extreme of any market, a huge run up here. And with the small product, this is in the midst of the biggest outlier we've seen in currencies since Brexit. This is less than $1,000 per contract, which is nothing to scoff at, but relative to big futures contracts that would have in the same time moved thousands and thousands, it's nice that you've already reduced the size. Now, Mikey, another thing, and I hope people don't think that I'm like being a jokester here with like I'm being passive aggressive or anything like that, with the idea of like, how do you reduce risk? Well, you get smaller. Seems easy enough, but a lot of people don't maybe think about that. Another way to reduce risk is closing the trade. And when you're day trading, we talk about this all the time. If I'm putting on a trade as a day trade, not a trade that I'm trying to scale in or have for, a week or so, closing the trade is a great way to reduce risk. You're taking off all the risk of that trade. And we talk about this a lot with our standard deviations that we use for entry, but also for exit, Mikey. If I'm in trading this SFX, like you say, it moves 50 cents to $1 per day and it's volatile. It's really starting to pick up in speed. And I'm worried about the longer term trends. Well, if I jump in and I sell the market up 75 cents and it rallies another 50 cents, I can say, all right, I lost my $50. I'm out. I don't have to worry about the fact that it's up, 6 days in a row, 18 of the last 20 days. I don't get caught up in those trends. I can close that trade for both a profit, hopefully on the day trade, 50 cents in my favor, but also closing the trade is an underrated form of risk reduction.
Yeah, the other thing you can do here, which isn't always a two-way street, is you could trade more contracts of a smaller notional size. And then you're actually reducing your risk by just peeling off one contract. Let's say you put on 3 in the SFX, maybe you're putting $500 in margining there. If it reaches a certain level that you're comfortable taking some profits, just close one of the positions. You can't do that with a larger contract. You can't split it into smaller pieces, but starting with a smaller contract size, you can add more and adjust your risk accordingly.
Great idea there is scaling in and scaling out on that day trade. Like you say, if you have three contracts, the buying power in SFX below $200. So the size is pretty small in that market. It only moves about $50 a day. It's like, oh man, I could do probably three of those contracts. Like you say, Mikey, maybe you sell, instead of selling all three here, you sell one here, you sell one up $1, you sell one up $1.25, you scale in. And then if that market continues against you, another, 30 cents, 40 cents, 50 cents, you take off one, you still have skin in the game if the market comes back, and hopefully you get to profits. Because managing losses frees you up for all of this back and forth trade. I don't know how many times I've done this where a market's rallying, especially in crude. I've done this recently. Market's up $3. I sell it. It goes up to being up $4, Mikey. I take that off for a quick dollar loser. And then before you know it, it's up $5. And I'm like, all right, I can jump back in. I just missed out on a full dollar in losses there, and I'm flat. I can get right back into it. So much trading to be done in small US dollars. And last piece, maybe you can speak to this. I know you've been looking at collars and different option strategies recently. You can also, if I'm short SFX, Mikey, I can short a put against it, or if I'm long, I can short a call against it. That increases my odds theoretically from 50% to 60, 70, maybe even 80%, depending on how aggressive with the short option. And I can also buy an option against it as well. If I'm short SFX, I can short a put, or I can buy a call, or I can do both in the collar. Maybe speak a little bit as we close out here to reducing risk with those options.
Yeah, exactly right. I mean, when you just have an outright futures contract, what are your choices? You can go long the contract, or you can go short the contract. You're going to take some directional bias there. Finally, there are options on both the small US dollar and the small precious metals contract. So you can get really creative in your trades. You can bring in some short premium credit to kind of reduce your deltas exposure there, to soften the movement of your underlying position. Or you can just trade outright like naked strangles or iron condors or vertical spreads. So even further reducing the size, the buying power, and the theoretical risk from trading the outright future, giving you a little bit maybe higher probability trade, depending on how you structure it. A lot of cool stuff you can do with the options.